Have you ever dreamed of becoming financially independent, but the thought of investing in the stock market makes you feel overwhelmed? Investing doesn't have to be complicated or intimidating. By understanding the basics of stocks and bonds, you can build a diversified portfolio and start your journey towards building your wealth. In this video, we'll show you how to get started with investing in stocks and bonds, and how to manage your investments to achieve your financial goals. Whether you're a beginner or have some experience with investing, this guide will give you the tools and confidence to take control of your financial future. Stocks. In this video, we'll explore the basics of stock and bond investing, and show you how to build a diversified investment portfolio. Let's start by talking about stocks. A stock represents ownership in a company, and when you buy a stock, you become a shareholder in that company. There are two main types of stocks, common and preferred. Common stocks give you voting rights and the potential for higher returns, while preferred stocks offer a fixed dividend payment and lower risk. When researching and selecting stocks, it's important to consider factors such as the company's financial health, earnings growth, and industry trends. It's also important to assess the risk associated with investing in a particular stock. Some stocks may be more volatile than others, meaning their value may fluctuate more often and by larger amounts. One popular tool for assessing risk in stocks is called beta. A stock with a beta of 1.0 moves in line with the overall stock market, while a beta greater than 1.0 indicates the stock is more volatile than the market, and a beta less than 1.0 indicates the stock is less volatile than the market. By investing in a diversified portfolio of stocks, you can reduce your overall risk and potentially earn higher returns. In the next section, we'll explore bonds and how they can also play a role in your investment portfolio. Bonds. A bond is a debt security that represents a loan made by an investor to a borrower, such as a corporation or government entity. When you buy a bond, you're essentially lending money to the issuer, who agrees to pay you interest on that loan for a specified period of time, known as the bond's maturity date. There are several types of bonds, including corporate bonds, municipal bonds, and treasury bonds. Corporate bonds are issued by companies, while municipal bonds are issued by state and local governments, and treasury bonds are issued by the federal government. When selecting bonds, it's important to consider factors such as the issuer's creditworthiness, the bond's yield, and its maturity date. Like stocks, bonds also carry varying degrees of risk, with some bonds considered more risky than others. One common tool for assessing the risk associated with a bond is called credit ratings. Credit rating agencies evaluate the issuer's ability to repay the bond and assign a rating, with AAA being the highest rating and D being the lowest. By incorporating bonds into your investment portfolio, you can further diversify your holdings and potentially reduce your overall risk. In the next section, we'll explore how to build a diversified portfolio that incorporates both stocks and bonds. Building a diversified portfolio. Let's discuss the importance of building a diversified investment portfolio. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, and cash, as well as different sectors and industries within those asset classes. By diversifying your investments, you can reduce your overall risk and potentially earn higher returns. One popular strategy for building a diversified portfolio is called asset allocation. Asset allocation involves determining what percentage of your portfolio should be invested in each asset class based on your investment goals, risk tolerance, and time horizon. For example, a more conservative investor may choose to allocate a larger percentage of their portfolio to bonds and cash, while a more aggressive investor may allocate a larger percentage to stocks. It's also important to periodically rebalance your portfolio to ensure that it remains aligned with your investment goals and risk tolerance. Rebalancing involves selling assets that have increased in value and buying assets that have decreased in value to maintain your desired asset allocation. By building a diversified investment portfolio that incorporates both stocks and bonds, and periodically rebalancing your holdings, you can potentially achieve your financial goals while minimizing your overall risk. Managing your investments. Now that you've built a diversified investment portfolio, it's important to manage your investments effectively. This involves monitoring your portfolio, rebalancing it as necessary, and considering the tax implications of your investment decisions. First, it's important to regularly review your portfolio to ensure it remains aligned with your investment goals and risk tolerance. You should also keep an eye on individual holdings to make sure they continue to perform as expected. If your portfolio becomes unbalanced due to changes in the market or your personal circumstances, it may be necessary to rebalance by selling or buying assets to maintain your desired asset allocation. When managing your investments, it's also important to consider the tax implications of your investment decisions. For example, if you sell an investment that has increased in value, you may be subject to capital gains tax. On the other hand, if you hold an investment for a year or more before selling it, you may be eligible for a lower tax rate. Finally, it's important to consider the fees associated with your investments. These may include management fees, transaction fees, and other expenses. By choosing low-cost investment options and monitoring your fees, you can potentially save thousands of dollars over the long term. By effectively managing your investments, you can potentially maximize your returns while minimizing your overall risk and tax liability. Investing in stocks and bonds can be a smart way to grow your wealth over the long term. By understanding the basics of investing, selecting the right stocks and bonds, building a diversified portfolio, and managing your investments effectively, you can potentially achieve your financial goals and secure your future. Remember that investing involves risk, and it's important to do your research and seek professional advice before making any investment decisions. With a solid understanding of the principles of investing, however, you can build a portfolio that is tailored to your individual needs and objectives, and potentially reap the rewards of your efforts for years to come. Stop everything, this is important. Ready to level up your financial game? Subscribe and like MoneyUp for daily tips, tricks, and insights to help you reach your financial goals and take your wealth to new heights.